items tonight. Our first one is the initial resolution authorizing general obligation bonds in an amount not to exceed $47 million. And I think Tim Stelmark is going to do that. All right.
Good evening, everyone. Here tonight to assist me with the presentation is John Meehan of R.W. Baird. Our regular contact, Brian Brewer, cannot be here tonight, but he, I, and Superintendent Kierkegaard reviewed all of this data last Wednesday. So without further ado, let's go to the first slide. I'll get it right sooner or later. The current debt outstanding. As many of you already know, the district has actively paid off prior debt from the 2009 and 2012 referendums. And as of today, January 14th, the district has the following principal outstanding. I know it's kind of hard to read that on the slides, but I'm hoping all board members have the electronic version. In Fund 39, that would be referendum approved debt, $29,420,000, and in Fund 38, that would be non-referendum approved debt, a little over $5 million. An important point is we have budgeted this year $4,800,000 of principal, which will be paid off this year, and the final payment on existing referendum debt will be done in 2028. I repeat that point. The final payment on existing referendum debt will be paid off 2028, and that creates a strategic opportunity for structuring new debt. As far as interest cost is concerned, from a business manager perspective, the interest cost is really low at this time. Based on rapid debt retirement, we have taken some of the most expensive debt within the past 12 months and prepaid. We have ARA stimulus bond subsidies. These are also known as Build America bonds. Give you an example, if we took out debt at 3.5%, the subsidy would be about 1.5%. So the net interest that the district would be paying would be around 2%. There are several issues that we have right now with outstanding debt that are subsidized. And of course, we still, relatively speaking, are in a low interest rate environment. The next point, the debt outstanding as a percent of equalized property value is less than 1%, 0.66. The statutory limit is 10%. With my experience in school business management, I've never seen a district that's really approached 10. But I do know also from that experience that 0.66 is one of the lowest percentages in the area. And the last point here on this page, the mill rate for referendum approved debt, that would be if we didn't do anything else in the district but pay our debt, would be $1.01 per thousand of assessed valuation. Our total mill rate this year is 7.97. The state average, I believe everyone has heard, is around 9.79. Many districts over 10. And this also is one of the lowest total mill rates in the area. Going to the next page. Financing goals of the proposed referendum. And it is indeed important to articulate the goals. First, minimize the referendum mill rate increase And right now, we're estimating that to be 13 cents on $1,000 of assessed valuation. We totally want to minimize the financing cost. We want to mitigate, we want to lessen the interest rate risk, and of course, we want to maximize the investment earnings. And with that, I'll give the microphone over to John for the review of the referendum financing assumptions.
Thank you. Good evening. I'll just walk through some of this information that Tim's leading me to. When calculating the impact of any borrowing, you have to start with an assumed bond issue size, borrowing amount. And for purposes of the math, we're using $47 million. You then have to take an estimate as to what the interest rates can be. And for the planning purposes, we're using 4.25%. Though it's on the a conservative higher estimate, it's an estimate we use at this point for running the math. And as far as the interest rates remaining low, and you'll be able to press that formula which Tim had mentioned earlier, this chart looks at a historical reference of municipal bond rates. And it goes back to, really goes all the way back to 1989, which goes all the way back, and I've been doing this for 30 years, so it's about as long as I've been doing this, as I look at this time period. And you can see on the left side how interest rates have been as high as 7.5%, 8% for 20-year borrowings, and how it has trended lower to the box on the far right side, which is the time period we are in now. And then over the past year, it just shows above. Yes, it's gone up a little bit, but interest rates go up and they go down. We're fortunate that in Wisconsin, debt issues are well received. The marketplace appreciates that Wisconsin credits are strong credits, including the West Bend School District. Going back to the assumptions, as I mentioned, we use 4.25% for the purpose of running the math. Current interest rates are more in the 3.5 to 3.25 range. As interest rate change, like for example, a 1% reduction, and right now we're saying we have about a 0.5% cushion, but a 1% reduction in interest rates will have a interest cost benefit of about $7 million. So that's significant over a 20-year time period. The repayment schedule, according to statutory limitations, is 20 years. That's how long a debt can be issued. We've used a 19-year repayment structure. We know it's always been the goal of the district to pay off debt sooner rather than the full 20-year time period. So we're actually using a 19-year repayment structure. And we've taken a look at the existing debt which is being paid down with the opportunity to back-end load around the debt itself. What we're seeing now is interest rates are very flat. From the 1 year to the 20-year time period, the interest rate range is no more than 1% for the first of the 20 years. So there isn't the normal, what you would see as a sharp ascending interest cost the farther you go out. So we're able to actually benefit from the existing structure and the current interest rates to structure around the existing debt. But we end up with a level of combined debt service for the debt. Now, as far as the property growth, to calculate the mill rate, we're using a 1% growth in valuation. Over the past 5 years, the average has been 3%. So we've seen an increase in the valuations, but yet for the math, we're using a 1% growth. As far as the referendum tax impact, the referendum amount is $47 million. That is the amount that if you approve the resolutions would be placed on the ballot. It would be the dollar amount that would actually be voted on. The question which was asked earlier, the total interest cost using that 4.25% assumed interest rate is $27 million. So similar to one's own mortgage, there's a principal amount you borrow and there's interest on the amount that's being borrowed. So the total of the principal and interest is approximately $74 million. And once again, these are based on estimates at this time, but we do have some cushion in the rates.